Good morning, everybody. My name is Patrick Small, and I'm the Managing Director for Dual North America. I run the flood insurance and specialty peril property practice for Dual, and I'm based here in Chicago. I'm also the chairperson for the Association of Lloyd's Brokers, and I'm here to moderate our session this morning entitled The New Threat Environment. Before we get started, I just want to let everybody know the format's a bit different than we've used in the past for some of our presentations and panel discussions. In that this will be more of an open dialogue amongst our panelists, in which I hopefully will be a good shepherd of getting our discussion moving in the right direction and keep the conversation lively and informative. So in lieu of presenting a PowerPoint deck of slides, I'm going to introduce you to the panelists and presenters, and in turn, let them tell you a little bit about themselves and their areas of expertise, and then we'll delve into the content. So to begin, when we thought about the session this morning and discussed the idea of a relevant topic, it really snowballed into a great conversation. And out came of that the theme of new threat environment. It seemed like a great topic. In fact, it is, and certainly has yet to disappoint in a world of constant change. The only issue we had was needing to pare back all the content that could be presented to you today. So we really had to work hard to whittle it down. So new threat environment is a broad topic, and it's intentionally so. And it's designed to include a few different disciplines in the products insureds use to manage the risk in unsettling times. Things like war risk, geopolitical risk, inflation, COVID, pandemic, tech threats, civil unrest, et cetera. I can stop there because obviously, both personally and professionally, the list of headwinds could go on and on. So really the question becomes, how in fact do you manage risk in unsettling times? So for today, we have a great group of panelists, two of whom are close colleagues of mine from Dual here in North America, and a third joining us from London from Miller Insurance Services. So we've got a very large bandwidth of time zones being covered from Northern California all the way to London. And I want to thank all of our participants for certainly joining our panel discussion, and certainly to the audience participants as well. So a little housekeeping before we start. We will be soliciting questions as we go and take pause on occasion to address those inquiries. And or based on the flow of the presentation, we'll take those at the end of the session. Further, we will have a 10-minute break about halfway through the session, so please stay logged in. I'm going to have Mark Rector here assisting me just comment on how to do that. And I'll be certain to let you know, when we stop and when we will be resuming the session. Lastly, I wanted to mention that this session does provide 3 hours of continuing ed, and in order to receive the CE credits, I'll have Mark leave some instruction on how to do so. So the outline of our broad coverage of topics today, we kind of had to put it to some silos here to kind of contain what it is that we want to do. Certainly, we want to discuss the different product lines that each of the panelists cover. Where do the product lines fit between property and casualty? Who buys the coverage? How are current events affecting the exposures for buyers? What kind of capacity concerns we have and capacity availability? And then lastly, certainly but not least, advancements in product evolution. So hopefully we'll amongst those kind of 6 pillars of thought, we'll find a harmonious break in there somewhere halfway through, take a quick break, certainly entertain any questions, and then continue on. So without further ado, I want to introduce the panelists, and in turn, I'll turn it over to them to have them give a little background and bio, and then we'll jump into the topics. So with me today are Larry Baldino, who's president of the Cyber Technology and Professional Liability Vertical for North America, or Dual North America rather. David Elliott, who's head of terrorism and political violence for Miller Insurance Services, and lastly, Mark LeBlanc, managing director of our Dual Crisis Management team. So with that, if I could get Larry Hughes to start with a little bio, and then we'll follow with David and Mark and get going.
Great, thank you, and thank you everybody for attending today. So as Patrick said, my name is Larry Baldino. I am the head of Dual Cyber Technology and Professional Liability. We are based out of Charlotte, North Carolina. I sit in Connecticut. I've been with Dual for about 2 years now. Previous, I have about 22 years of experience, all in cyber and technology, predominantly with Chubb as a prior carrier.
Sorry. Hi everyone. I'm David Elliott. I head up the terrorism and active assailant practice here at Miller. I'm based out of London. Miller is an independent broker. We've been in existence since 1902. I've been at Miller for over 20 years now, and have seen a huge amount of development and change in the marketplace here in London and internationally.
I think that's me now.
Yes.
Hi, everybody.
You.
Mark LeBlanc. Thanks for your time this morning. I'm the one who's based in Northern California, so it's 7 a.m. and I've got a couple high schoolers getting ready to go to school. So if you hear some clanging of dishes, I apologize. I've been doing this since the late 90s. I started my career at AIG, always been based on the West Coast. And I'm going to talk about product recall and product contamination today.
Thank you, fellas. So David, so to begin the discussion in the panel overview here of a product and the six verticals that we look to cover today. As we live in a very active and globally geopolitically charged environment, gives a little flavor on political violence. Certainly overview of the product, maybe add some color to the variations of product and terminology. And along those lines, I'm thinking terrorism versus civil commotion versus political violence. Things that may confuse us as brokers, wholesalers, retailers that would have to use the product and discuss it with their clients.
Sure, absolutely. So, I mean, it's probably worth just sort of, I guess, taking a little step back in time to the sort of the origins of what I call the standalone terrorism and political violence market. At the very start of my career, I joined Miller right just after 9/11. Obviously, it was a very traumatic time for everyone. At the same time, the all-risk underwriters withdrew coverage in respects of terrorism and standalone terrorism. At the same time, lenders mandated that coverage be offered to insureds across North America. And this is going to be quite a focus on North America, but it will be North American insureds who may have international exposure. But it was sort of, for the background, I'm going to concentrate more on for US and North American clients. Shortly thereafter, there was the introduction of the Terrorism Risk Insurance Act, which was designed to provide a backstop to the private market that were dealing with having to offer terrorism to all the insureds and it was actually mandated that all insurers actually offer that coverage. So it was fast forward a few years when a sort of growth in terms of capital coming into the market, the standalone terrorism market grew. TRIA, the Terrorism Risk Insurance Act, continued to be offered by the all-risk underwriters, partly because it was mandated, but also it was something which everyone just got into their habit of doing. All the while, the standalone terrorism market was probably, in some instances, uncompetitive, but for the more sophisticated buyers and more complex risks, it offered a sort of a viable solution. Fast forward, then another further probably 15 or so years, the terrorism market had got to a point of being very, very competitive, so much so that it was able to compete in terms of price with the US offering of TRIA. The important differential was that it was under set terms and conditions, definitions of terrorism, which encompass both foreign and domestic acts of terrorism, which initially the TRIA did not. TRIA was only offering terrorism for foreign acts of terrorism. It then latterly offered the domestic acts, the Timothy McVeigh type example. But the issue with TRIA, and the fundamental issue with TRIA, was that, and it still remains, is that it has never actually been properly tested. There is a rather complex mechanism by way of that the scheme would effectively require some degree of clawback, because very importantly, TRIA is not actually a loss reserving fund. It's a promise to pay in the event of an act. That act would have to be certified to be an act of terrorism by the US Secretary of State and various other factions. And the cynics would argue that it actually creates an argument, or it could be used as a political weapon in terms of argy-bargy between different sides as to whether or not to certify something. Because if it was a big catastrophic loss, it would actually cost the government a huge amount of money, of which they haven't actually got a pot to pay those claims. Compare that with the likes of the UK Pool Re, the French Gariat. Those are government-led schemes which actually don't, they've actually got pots of money where, as people have paid in premiums, they have a loss reserving fund. So the cynics of Trier would argue that it would, in terms of timings and certainty of cover, it is questionable. And arguably, if the standalone terrorism market was willing to offer coverage, broader coverage at better pricing, then it becomes a very viable option. I think it's probably fair to say that the market who offer this, they are in the business of paying claims for the peril. I think that's the other big differential. And I think we talk about changing appetites of underwriters, the sort of the almost mind the gap of these things, where all risk underwriters in certain lines of business have traditionally covered things until there's a lack of appetite for that particular exposure. We saw that on cyber, where cyber was not excluded a number of years ago. Now everyone, obviously, it excludes cyber. We're seeing that more and more in respects of, as Patrick mentioned there, the strikes right civil commotion. We saw the huge losses that originated out of the protests following the George Floyd murder. That was the riot, that was unprecedented. On the all risk side, we're going, okay, we're paying out for losses that we did not anticipate coming. And I think for a lot of underwriters, that causes major problems. There's one thing to be able to model risk and charge adequate premium for it. But if you're paying out losses for eventualities that you didn't realize were there, that causes problem. And so we're seeing a sort of a change in appetite for those sorts of exposures. That change is then leading to also, it's fair to say that terrorism as a threat around the world has actually changed what it actually looks like. Back in the day, the definitions of terrorism were explosive devices, the large truck bombs and the like. Now, sadly, those things are still happening, but we saw a growth of almost person-on-person exposures, where the primary goal was to kill and maim rather than create a huge hole in the ground. So definitions of terrorism have also had to be broadened to make sure that it doesn't look to exclude events that have happened for by different means. So gun, sadly, a very strong example of that was the Charlie Hebdo attack in Paris, where, undoubtedly an act of terrorism, but slightly perversely, that would not have been deemed to be an act of terrorism as per Trier, because the amount of property damage that resulted from that atrocity was not enough to trigger, would not have been enough to be recognized as an act of terrorism under the Terrorism Risk Insurance Act. So I think we see sort of the market is trying to make sure it addresses how the change of threat has materialized over the years, but also looks to make sure that it offers affirmative cover. Affirmative cover, I think, is one of the more important things, for any insured. The reliance on an all risk policy to you're covered unless it's excluded, and almost that taking that slightly dubious approach of saying, I'm okay because as long as it's not excluded, I'm going to get it covered, is theoretically possible. And, I guess it's for eventualities that have never been thought of. But when C-suite are asking their risk manager, have we got coverage for this? The answer of, well, it's not excluded from our all risk is sometimes not good enough, which sort of leads us on then to, I guess, the sort of the topic of active assailant. Active assailant is a sort of almost it's a furthering of the violence that is being seen, particularly sadly in the US, where mass murders and active assailant events are happening almost on a daily basis. But active assailant doesn't necessarily need to encompass It doesn't require it to encompass an individual waking up one day and having that intention to commit mass murder. What the policies can also then cover is the escalation of violence. So an argument that gets heated, somebody goes to their car, grabs a gun, comes back with the intention to maim and hurt. The policies need to make sure that they encompass those sorts of eventualities. So and also be almost agnostic as to what the actual intention was behind it. In a manner of speaking, it doesn't matter who's done it, why they've done it, or how they've done it. All that matters is that the insured themselves have protections, and that they don't want the obstacle of a court case to decide whether or not there was or was not liability, there was or there was not an individual who was acting for and on behalf of a terrorist organization. They want to be back up and running as quickly as possible. So the active assailant is very much one of those products that it doesn't just need to be covering the risk transfer aspect of things, but it also needs to encompass the crisis management, the response to get the insured back on their feet as quickly as possible. And I think we've seen a big development in how that offering is articulated to insureds and the benefits that it can provide to them. I think taking the example of cyber, you would nowadays, I think most people would argue, wouldn't dream of trying to handle a cyber breach by yourself. So the role that crisis responders play in our environment is growing and growing, and the added value and the expertise that people effectively are buying into and looking to effectively have on retainer, because when an event happens, they're looking to make sure that they've got proper support around them. And I think we're just that development of the product to make sure that it moves and flows with the actual requirements of the insureds, I think is hopefully a sort of a common thread that we'll see across today's presentation. But the world is changing. I mean, sadly, the conflict in Ukraine is causing people to, that was an unexpected event. There's no doubt about it. The pundits were there was a very low possibility of doing what Putin actually did. And sadly, it has impacted, and it will impact the global economies. I think that on the back of COVID, the energy crisis that is only being exacerbated by attacks, though we had the Nord Stream attack the other day, which has been purported to be sabotage. I think all these things are going to put pressure on the global economy, on global sentiments. Violence is sadly a way that people decide to express their frustrations and anger. And so we are only going to see a continuance of this. So the importance of making sure policies are fit for purpose, make sure they're affirmative coverage, and they actually do what is intended, so that the insureds can then get back up on their feet as soon as they can after an event. We firmly believe that the role of a risk manager is to future-proof the business, to make sure that they can survive whatever hits them, be it a windstorm, quake, active assailant, political violence, that they are back up and running as quickly as possible. And the insurance products should definitely be supporting that, to make sure that they're provided by expertise and the risk transfer aspect, to make sure that they can continue for the future.
That's great,
Hopefully
David.
That gave a little bit of a semblance of the product.
That's awesome. That's perfect. I think what's so great about the three of you is that I think there's some gray area where certain policy coverages are intended and where certain coverages are not intended. So it'll be interesting to gain Larry's perspective and then Mark's perspective, because I know there's an element of political violence probably in both of their products and programs and the scope of how they develop products. So moving on to Larry, if you could kind of really do exactly what David did, give us a kind of a broad brushstroke on the cyber world. Obviously, there's a lot of elements of probably some political violence, as well as certainly when we get to Mark, we'll talk about crisis management on a different scale.
Yeah, absolutely. In fact, David already did all the hard work for me, because it's really funny as I listen to what David had to say and how trajectory of political violence and how the coverage is sort of developed. And David, I actually used to underwrite the workplace violence coverage quite a bit, which I think has sort of evolved into your product today. But
yeah,
is that still something because you're mentioning the individual, like, scenes of shootings and stuff like that? Is that something that are people still buying both, or is it?
Yeah, I mean, it's an interesting question, because I think what we're seeing is who buys those and what their motivation for buying those particular products are. I mean, the workplace violence is, I think a lot of people are buying that. A lot of people are buying the active assailant for that much larger doomsday scenario.
Yeah.
But the two obviously completely cross over. Where there's a sort of an involvement, or almost a bit of a stumbling block at the moment, is the fact that the active assailant policies won't cover things like the stalking threat and things like that, which a lot of the workplace violence policies do. I think it's also the cost of the price point. The workplace violence policies are comparatively very cheap, whereas some of the active assailant will, with just the breadth of coverage and the support it gives, are more expensive. So it almost cost-wise, it still works to buy both and gives you that much broader sense of coverage.
Yeah, that's fascinating. Well, we see a lot of similarities in the cyber world. I mean, obviously some of those hot topics like cyberbullying and some of the, political violence stemming from cyber type exposures. To be honest with you, even attacks like Nord Stream that you bring up, now I know it looks like that was sabotage, but in theory, and we have seen this actually play out in some cases, you can actually have that be conducted via a cyber attack. So there is a way, as systems kind of evolve and the Internet of Things gets together, where a lot of those companies, so chemical companies and petroleum and all that stuff, a lot of those pressures and stuff they're doing is regulated online. So one of the first things, it was interesting, there were a few incident response firms that one of the first things when Nord Stream, when the explosions happened, they actually were looking into the fact that it could have been Russia conducting it via a cyber attack, because in fact there was a bulletin put out by the FBI not that long ago saying that Russia may attempt to hack infrastructure and create sort of panic and destruction via pipelines and stuff. So it just seemed very coincidental when it happened. So yeah. But in all honesty, like I said, the cyber world really has mirrored sort of what we had just heard. I mean, I had been in the cyberspace pretty much since its beginning. Now there are forums out there that say they covered network exposures back in 1989. I saw something circulating on LinkedIn saying that there was computer virus coverage back then. But really, we started as an industry focusing on cyber around 2002, 2003. And, coincidentally, it was shortly after the 9/11 period you started with David. And, really the coverage and the policy wording and everything has evolved tremendously. So, back then in the early days, a lot of it was, how do we contain wild viruses, that were basically targeted attacks against the individual firms. And then a lot of liability coverage as well. So, libel, slander, defamation of character, stuff like that people started on the internet. It's not as rampant as it is today, but, we did see a fair amount of advertising injuries and personal injury type claims coming through on the cyber policies in the very early days. And then around 2008, we started to see the need for the forms to morph into where they are today, which is really a comprehensive first and third party policy form. And that's because that's when we started to see the first real data breaches happen. And in the beginning, it was really, stemming from the large organizations, the Bank of Americas of the world, the larger hedge funds. What was interesting in my previous role, when we were doing a lot of the Fortune 500 companies, we started noticing this trend that there was some theft of funds and things being taken offline out of their accounts. And then we had our first ransomware attack, or what would have been qualified as a ransomware attack, where literally it was a virus that was directly deployed into a certain system, and they received a phone call just like a traditional ransom case would be. That's how it was very labor intensive and time consuming. And again, for years, these cyber attacks really targeted sort of the larger risks. And so the industry sort of priced itself appropriately in that term. And we really didn't have any kind of qualified modeling at that point. So we were using a lot of professional liability based pricing models and stuff, and charging a lot for the larger organizations. And basically we're giving it away. And the SME business, it was really cheap. You could buy big limits, and the market sort of did what it usually does. It was sort of a race to the bottom in the cyber world. And then as a lot of events in the world started changing, again, I won't rehash everything David had just said, but really in the same parallel, around 2018, 2019, we started seeing, hackers and cyber criminals, commoditizing things a little bit. And then, the introduction of Bitcoin and some of these untraceable currencies. And then the pandemic happened, and it created sort of a perfect storm. So basically from 2018 to today, the cyber market has evolved tremendously. And I think anybody who is working in the cyberspace, whether you're selling the coverage or underwriting, whatever, you've seen things change, literally on a dime. Again, I mentioned the sort of the commoditization of cybercrime. Ransomware has gotten significantly cheaper. Hackers have sort of figured out a way to almost sell it as a service now. So anybody with a basic knowledge of script and form fields and stuff can go into can break into softly targeted organizations. They're running the same vulnerability scans that a lot of insurance companies are to find vulnerabilities, and then they're exploiting them for nefarious purposes. Obviously, ours are for the good, to let the insured know. But that's where we really saw the rise of ransomware, and it was only exacerbated by the whole pandemic. We had a whole bunch of organizations that, to that point, had never worked remote. All of a sudden, we're forced to go, completely remote. And what we saw was a tremendous increase, over a 500% increase in uptick in ransomware claims. In fact, one year it was like from 2019, where the average industry loss ratio was in the 30s, went to about 80 just overnight as we saw the explosion of these ransomware claims. And the other trend with that is they were still hitting large organizations, but that commoditization really morphed into them hitting small, less targeted organizations. So again, going back to those first few claims, every single one of those ones we had, the FBI was involved, sometimes the NSA, Secret Service, if it was a financial institution. And they really went after the criminals. So, they then pivoted and started chasing small business and asking for small amounts. So ransomware demands were not hundreds of millions of dollars. They were $10,000 to your local pizza store or pizza shop. So we started seeing that come. And so the industry loss ratio went through the roof. And so that is why today, and then obviously with everything going on geopolitically, the war in Ukraine, threats to our infrastructure, because again, I mentioned the whole Internet of Things. That's why the cyber market has kind of gone through this period of turbulence where, insurance carriers are managing limits and aggregation appropriately. We are coming up with sort of a universal response to terrorism, which I'm sure we'll talk about. But we're seeing limits be reduced. Capacity is a challenge for any MGAs out there. And, really the pricing has doubled and tripled. In fact, we've had a few renewals on the technology side that have seen 1,000% increases over the last 2 years. Now, obviously, that's not sustainable, but it's kind of going through that period of turbulence right now.
Thank you, Larry, for that. Again, it's interesting to see the overlap and the continuity and the topics we're covering this morning. With that, Mark, if you could give us kind of an overview. I always find your presentation fascinating, because to me it's a slightly different insurance product and how it's thought of and purchased. I know your crisis management may not resonate with everybody as product recall, so maybe you could just start there and give us a kind of a top-down view.
Thank you, Patrick. It's kind of interesting listening to both Larry and David speak to their specialties. When I started my career, I was an underwriting trainee at AIU in San Francisco, and I handled a small portfolio of kidnap, ransom, strike riot, civil commotion, product contamination, and I sat in between the terrorism, trade credit, and political risk underwriters. So I've been around these lines kind of since my career started. But I think the main overlapping theme here is that we're all niche specialty products, but we're all born out of exclusion buybacks when you think about it. So a lot of our coverage really came about from significant events, whatever those events were, where there was not ample coverage in traditional lines of insurance. So where product recall and contamination come into this is that we're actually born out of kidnap and ransom, that product. So kidnap and ransom for a long time had a product extortion trigger. It also, Larry, I've got PTSD from this, had a cyber extortion trigger as well. But it wasn't underwritten for those perils. It was underwritten for kidnap and ransom. It had these whistles and bells hanging off of it, where if somebody extorted a company's product and that company was forced to recall that product, there was a recall element. If there was a cyber threat, there was a recall element and a business interruption element to a cyber threat. So what ended up happening is companies were buying these coverages for one core trigger and then having these kind of side issues come up, and underwriters were realizing that they weren't collecting the premium, they weren't really underwriting to these additional exposures. So what happened with product recall is first it started with malicious product tampering. That was kind of the beginning of our product. And there were a couple incidents in the 80s, maybe early 90s, of situations where products were tampered with in stores, products were tampered with in homes. Companies didn't know how the tampering took place. They had to stop selling the product because they couldn't figure out where in their supply chain or where in their processing that incident occurred, whether it was them doing it, whether it was a mistake, or whether it was deliberate from a customer or an employee. They didn't know. So insurance being an opportunistic business, underwriters began to break that stuff out and offer it monoline at incredibly hard market terms. So we're talking limited capacity, incredibly high rates online, very narrow triggers. So companies started to buy malicious product tampering as a standalone, more or less in the 80s and the early 90s. But then they realized that actually their exposure was not on the malicious side, it was on the accidental side. So it was the mistakes that the companies themselves were making to the production of their product. And that was really where the bulk of the exposure was. So the insurance industry, of course, sees an opportunity, finds a way to begin building coverage, begins pulling these kind of languages out of policies from property, from GL, stripping it out of that, looking at where there's exclusions in the standard P&C market, and beginning to build a more robust standalone coverage. So when I started in the business, late 90s, the majority of companies that we had buying product contamination, I'll get into the difference between contamination and recall in a second, but the majority buying contamination were large, well-known brands with significant reputations, significant product processing, significant exposure. They were exporting their product. They were making it overseas. They were, making it in Latin America, sending it to North America, making it in North America, sending it to Europe, making it in Europe, sending it to Africa. So they had definitely the exposure. They had the balance sheet exposure. It was not addressed by property. It was not addressed by GL because, again, property excludes the product, and GL is damages to the injured party. It's not to the first party. So that's really where our coverage came from. And then it's begun to evolve because first it started as a food, largely product, but then it evolved into automotive and consumer goods. Because as we all know, the automotive sector, when people think of product recall, they typically go to one of two situations. They go to airbags, maybe they go to ignition switches, or maybe they go to leafy greens, ground beef, poultry. That's typically where people go when they think about these coverages. And really what has happened is that this market started dominated by AIG. And when AIG hit their financial troubles in the mid-2000s, a lot of the underwriters scattered and went and set up new shops. So at that point, what happened is all of a sudden the capacity began to grow, appetites expanded, coverage began to evolve. People started writing the automotive component supply chains. They started writing consumer goods more readily. They started writing pharmaceuticals a little bit, nutraceuticals, cosmetics. And the underwriters began realizing, and this was my own personal experience, that when the losses came in, they were actually collecting ample premium to begin expanding coverage and looking at more unique ways. And I think one of the themes that's kind of come through between what both David and Larry have talked about is the need for certainty in risk transfer. Because a lot of times when we look at exclusion buybacks in insurance, what happens is people pull one specific peril out of that. They build that product, they launch that product, they underwrite it, and insured comes back and they have an incident that doesn't fit that peril to a T. So there's contract uncertainty, there's claims uncertainty, that puts pressure on brokers, that puts pressure on underwriters, that puts pressure on carriers, on reinsurance, because ultimately you have these scenarios where it's not clean black and white, whether you have that trigger. It's a little bit more gray. And that's really been a challenge for our market in the contamination and the recall side, because we continue to find situations that don't fit the triggers perfectly. So to give you some examples, our insurance, product contamination and product recall, is traditionally triggered by a mistake that leads to bodily injury or property damage. But as the government regulation has gotten more involved and become more aware of the coverage, and they have different recall classifications, if you go through the different recall classifications from the FDA or the USDA, not every classification requires bodily injury and property damage. There's a couple that just require that the product is unfit for its intended use. So that's a classic example for our market of a gray area where a company is buying what they think is product recall. The government is stating that they need to recall, but they're not alleging or confirming that the product can cause BI or PD. So there's no necessarily guaranteed contract certainty from our policies that is going to address those situations. So there's a lot of burden on the underwriters in our market space to be a little bit more creative, think a little bit more outside of the box, and figure out ways to bring coverage to these buyers where there is less certainty, because ultimately what our policies cover, and this goes back to strike riot, this goes back to terrorism, this goes back to cyber, and this goes to our lines, kidnap and ransom, product contamination, product recall. We're the balance sheet protection in this equation. So if you're property, you're covering facilities. You're covering the revenue from those facilities. If you're GL, it's third-party damages and defense. But in our scenario, what our coverage is doing is it's refilling those holes in the balance sheet when a company has to either pull product, destroy product, or stop producing a product. And there's no other situations where they can put that under property, they can put that under GL. So because of that, we as a market sometimes do ourselves a disservice by referring to ourselves as product recall. So when people sometimes look at my business card or they look at my signature on my email and they say, what is crisis management? This is generally the pitch I give them, which is that if I tell you I'm product recall and you look at your portfolio of accounts or insureds or companies or clients that you represent, you might see a bunch of manufacturers and processors who are too far behind the consumer to think they have that recall exposure. The automotive sector is a really good example. There's so many components that go into a car, but GM controls the recall. Ford controls the recall. The people who make the brake pads, the sensors, the fasteners, the wire harnesses, they don't have control over the recall. The OEM does. So when they think of product recall, they don't necessarily see that they have that exposure. But in reality, what we're doing is we're refilling that balance sheet when that insured can no longer furnish that product to a customer or get it out to the stream of commerce. So I think in terms of what our coverage does is very powerful. How we articulate its value to a buyer, we have a lot of work to do as a market, because ultimately, if you go back to what David spoke about, you go back to what Larry spoke about, all of our coverages plug gaps in an overall risk transfer solution. And more importantly, we all are in sectors of our businesses, whether it's carrier or broker, where we are frankly challenged and incentivized to plug those gaps and find ways to mold the coverage and reach out and fill those holes in a risk management program. And most of us have the experience, have the scars, the bumps, and the bruisers to kind of know where we've missed an underwriting situation, where we've mispriced an account, where our competitors have, to understand how can we appropriately charge for these gaps, how can we appropriately analyze these gaps, set a loss pick, and find a way to plug them via the policy, but most importantly, craft the wording so that an insured sees certainty in that contract and that risk transfer. So going back to, kind of product contamination and recall, the main difference between our two definitions here, contamination versus recall, is contamination is really for food. So whether it's leafy green, whether it's ground beef, whether it's eggs, poultry, fish, think about the risks that come in those supply chains. Is it E. coli that comes from, unfortunately, the slaughtering of the beef? Is it heavy metals that fish are exposed to when they're swimming in polluted oceans? Is it salmonella that comes from a hen house on an egg farm? Is it E. coli? Is it listeria growing in a dairy factory? Those are the kind of risks that we see for contamination. So that's why that coverage is product contamination cover. And where that works out in the overall food chain is you've got the finished product company, they've got a reputational exposure. Larry touched a little bit on that about the reputational damage to companies. We do provide an element of reputational coverage, but that's really for a name brand company. That's really for your top 100 dairy companies, soda companies, what have you, snack companies. So we have that element for the food sector. It also, it could be, we have an incident going on right now with glass and rice. And I would say that typically do not invite product contamination underwriters to dinner. We're terrible when we get going. It's not, I don't recommend it. But so that's the contamination world. That's really where we started. The product recall side's a little bit different. Product recall is really for the finished goods. And I think one of the key things there is that it's about the defect of the product, right? Because our coverage is responding to the problem with the product. It's not responding to the allegation from a consumer or a damaged party. It's if you discover a problem with your product. So when you get away from food, it's really about the defect to the product. And whether that defect results in BI, whether it results in PD, or whether it results in it being less useful than it should be. And that's an interesting element that we brought into this coverage probably 15 to 20 years ago at this point, and that's called impaired property. And that's another exclusion buyback from GL. So again, most of what I've spent my career doing is living in this kind of space in between the standard lines of business, like we all have on this call, and finding out ways to make our coverage more relevant. And I'll be honest, we struggle with it being an adverse selection buy. We struggle with companies who have the exposure but don't buy because they don't see the value. So I am often jealous of our colleagues in terrorism. I'm jealous of our colleagues in cyber because so many people buy their coverages. And I think it's because, frankly, they've done a better job of articulating the value proposition of their coverage strictly by the name of the coverage, not the function of the coverage, but the name. And that's one place I kind of challenge the overall recall market to take this space to and these coverages to, is making it more relevant by the label of the coverage so that we're not stuck keeping buyers out of our market because they don't necessarily see their recall exposure. So with that, I'll kind of pause and see if anybody has any questions and turn it back over to our moderator.
Yeah, no, that's great, Mark. And we're actually coming close to kind of the midway point on our discussion today. So I've got one thought to pass around the horn here before we take our little 10-minute break. And not to be too elementary, we've got most participants to the ALB panelist discussions and events are a variety of retail, wholesale, carrier, legal, a variety of individuals. But I was wondering if each of you could just touch on briefly again, just a few comments on distribution, where the coverage is normally purchased, and if you could just clarify. I know we had the kind of the broader topic. Where do the product lines fit? Is it property? Is it casualty? Is it more management liability? I'm trying to think of the silos that we look at in how we approach a retailer or a wholesaler, where maybe you've got a retail specialist in property that doesn't necessarily talk to the casualty side of the house, that type of thing. I was wondering if each of you could just comment briefly, and when we're done there, we're going to take a break. But no rush. But it's about 10 to 10. So if we 10, 15 minutes, we could discuss that real quickly. Again, distribution, and then where the product line fits. David, always start with you. There you go.
Okay, fine.
Sorry, I can't kick you under the table. I forgot about that.
No, there we go. Yeah, so I mean, in terms of distribution, I mean, in coming to London market, and I think it's fair to say that in many instances, London has been a sort of centre of excellence for the sort of international standalone terrorism and active assailant. Though that we do know, obviously, that there are counterparts and direct competitors. Myself being a broker, people often ask me who my biggest competition is, and I say it's actually some of the direct carriers who offer the product. I think it does depend. It can be the TRIA obviously sits as part of the all risk pricing. The standalone terrorism goes through obviously on a retail or a wholesale basis into the market. I think we've seen changes to that in terms of more sort of direct marketing. But I think it's something which is, everyone needs to have that sophistication. And I think, as Mark sort of very eloquently put it, it's about, just making sure that it's fit for purpose.
Barry, how about you?
Yeah, so London is also a center of excellence in the cyberspace as well. Some of the carriers with the most longevity sit there. With that, the distribution has historically been predominantly wholesale driven business. However, with the popularity of cyber, as Mark said, it's now, sort of a common coverage that all businesses of all sizes are buying. Retail's like the fastest growing area. In fact, it's a distribution strategy that we are pivoting to. You do not see a lot of like direct writing of cyber business to insureds. That still has not been very popular. There are some very good platforms out there, and then obviously the wholesalers do still have an edge with the rise of some of the MGAs like the Cowbells, Coalitions, and Cornices of the world.
And Mark?
Yeah, I mean, our distribution kind of mirrors the product in general. It's very specialized, it's very niche. So a lot of our business comes from brokerage houses that have dedicated teams. I think in general, you can kind of draw the line a little bit between risk management and mid-market to small business. The majority of the risk management buyers tend to come from the retailers. That drops off when we move into the wholesale space. Wholesale space is very heavy in the mid-market and to an extent on the small business side as well. We also have some geographical trends. If you look at the United States, the majority of our heavy manufacturing is the Midwest. So a lot of that business comes to us through the Midwest. A lot of our lighter agriculture, and by that I mean leafy greens, produce, fruit, that comes from the West and the South. Dairy is a little bit scattered all over. And then London is an incredibly powerful player in our market space. They probably have the highest concentration of senior underwriters and capacity right now in the market. So a lot of that business does find its way through these wholesalers into the London wholesalers, Miller's, Besso, Howden Specialty. So a lot of those shops do also broke a fair amount of that business. But comparable to what Larry was saying about direct, it's very unlikely we see direct business.
Yeah, I can imagine. Well, good, fellas. This is a great spot to break. I'm going to let the man behind the curtain, Mark Rector, get us set for a 10-minute break. I've got 9:56, so let's aim to reconvene at 10:05 Central. I know most of us are in Central Time Zone, but 5 minutes after the hour, let's pick up the conversation. Thank you.
Thank you.
All right, welcome back, everybody. So it's about 5 after 10 here, and we look to finish at the top of the hour. So I think what we want to do is kind of move the discussion into some, again, some broader topics and see how each participant views, the views, has a view on those topics, if you will. And I think the first one of them, Mark, I wanted to get with you that you'd kind of hinted on. Much of any get some feedback there. There we go. Much of any consumer purchase is discretionary, but seeing that obviously certain insurance coverages are driven or motivated differently, and just wanted to comment, what do you see in the purchase cycle? Is there a lot of altruistic educational elements that go into it before someone can make that determination whether the coverage is needed? Is it more driven by insurance budget? Do they have enough money in the budget to afford the coverage, or is it one of these things where they want the coverage after it's slightly too late, and will either pay a very punitive rate to purchase a cyber policy after being breached, if you will? So just kind of, if you could comment maybe a little bit on, I guess, the purchase cycle. Again, I use the word discretionary because I think, Mark, you had hinted that it takes time and it's a little bit of a challenge to educate your, whether it's the broker to the insured, but ultimately the insured who's funding the policy. So, and we can start anywhere. I don't know, Larry, if you want to start, maybe we'll change it up a little bit.
Yeah, sure. So, yeah, I mean, it's technically, like Mark had sort of discussed some of the challenges. Yeah, I mean, the cyber hit ratios and what we're doing is, obviously there's a much more significant emphasis on writing cyber. Every breach and event that sort of happens triggers an uptick in purchase. But we still do struggle a bit too with it being a discretionary purchase. Until very recently, there's no contracts out there that say that you must have cyber insurance in place. There's no requirements by the federal law. Now, that's all changing. We're starting to see that, I'm starting to see a lot more contractual purchases of cyber, but right now it's still a discretionary purchase. And so there are still a significant amount of businesses, particularly SMEs, as well as some more mid-sized businesses that are kind of going without the coverage, and there's a lot of statistics out there that sort of estimate the cost of loss when you purchase coverage versus the cost of loss when you purchase without. And I mean, this might be a pie in the sky thing, but I don't think anybody sitting on this call, whether you're Mark or David either, I don't think these are discretionary purchases anymore. I think it's necessary to sort of build it into the budget. Does that make sense?
No, I think it does. David?
I think, the word discretionary is always a bit of a loaded one in terms of, I guess we saw the full extreme of non-discretionary when the lenders require you a mandate that you purchase. And I think it's the principle of, proper risk management, enterprise risk management, of people looking to manage their risk and what products go alongside that, rather than only the most lateral thinking of risk managers will consider buying it. I think in all sort of in the cyber and the recall side, if any risk manager has ever been through a loss, and particularly a sort of a not clear-cut covered loss, their biggest thing is to avoid that ever happening again. So I think the more of it's less sort of discretionary, it's more enlightened purchasing.
And Mark?
Yeah, I mean, I think I like David's distinction between discretionary and enlightened. Here's to an increase in enlightenment amongst our buyers. I think our coverage is typically a consultative sale. So a lot of times when companies are buying this, they're taking their time. There's a broker that's investing a lot of energy, that's doing a lot of research, that's shopping this out. And typically the sales cycle for a new buyer is relatively long. It's usually a year to two. Somebody kind of kicks the tires, looks at bids, gets an idea about what the spend is. There's almost always sticker shock when they first see this cover. It's typically not cheap compared to other lines of insurance. And that's a dynamic of the lack of enlightenment from buyers. It's when you have what's viewed as an adverse selection market, your prices are going to be higher. It's a severity line. So one of the things that we're trying to push at Dual as a market, just for us, but also for the overall space, is getting new buyers in, because ultimately that's going to drive prices down. But in terms of why companies buy it, typically the companies who do buy it are in a sector where there's activity. So maybe there's a recall on ice cream in the summer. You get a couple ice cream buyers who step in. Maybe there's a recall on some auto component. You get a couple of those coming in. So typically there's something that's happening in the stream of commerce or in the media, and people are aware of it, and that's what's bringing them into the market. But it is challenging to manage the expectations in that process. The brokers might have somebody who wants to buy, but the limits they want aren't available. Our total market has around 200 million in total capacity. So if you're a really, really, really large company, that may be insufficient for you. And you may not have the appetite for the attachment point that the market wants to open up all that capacity. So there's a lot of pressure on underwriters and brokers to kind of work together to manage those expectations of the buyers, because if we don't do that the right way, we're not actually growing our market at the rate we need to. And a lot of times what we end up with in our space is that the new buyers that come in, they come in one at a time. They don't come in by the boatload. So when we get a new buyer, it's somebody sucking up a lot of overall capacity.
That's great. Next question here I think, again, I'm going to kind of send these out and have each of you respond. And I think this next one actually applies to all, but, maybe Mark, not to have you do the heavy lifting this morning, but supply chain's an obvious one in the world we live in. But I'm sure supply chain can be disrupted by, cyber or a geopolitical position. What kind of constraints, kind of challenges do we have with supply chain in general? I guess, a big word that we throw around in a variety of different ways is inflation, whether it be, overall consumer inflation, claims inflation. What are your thoughts and comments around that as it pertains to your product and your product line? When I say supply chain and inflation, what does that mean to you? Is it something that's commonly discussed amongst your underwriting teams?
I mean, I'll kind of break them into two different parts. Supply chain, I think, is kind of unique to our space. If you look at the global food economy, the global food industry, the global automotive component industry, parts are coming from all over. Whether it's a raw ingredient, whether it's sugar, whether it's flour, whether it's metal, whether it's aluminum, whether it's steel, whether it's silica. That stuff's being sourced all over. And every time companies change supplier, the ability for them to do the due diligence of how much that new supplier does their product the same way their prior supplier does, that's limited. When you're an underwriter, you typically don't know your account your first year on the account. You know it just at face value. You have to be on that account for a while, probably experience a little bit of claims to really understand that account. It's the same thing when companies change suppliers. And COVID put a lot of pressure on that. So a lot of companies changed their suppliers. That's a challenge for us because a lot of our product, we end up subrogating against suppliers a fair amount, because a lot of companies in the overall food chain, if you will, in the industry, when they change suppliers, they get a bad ingredient, they go push back against that supplier to be made whole. A lot of times in our market, we pay that claim and we chase the supplier and we go after their GL or something along those lines. So what we run into is not only the fact that the changing in suppliers increases frequency with the the overall coverage, but we're also oftentimes going after foreign suppliers. So we incur costs when we have to do that work. A big value proposition, like I said, is for us to pay and chase. So, our idea is we don't point back to them and say, hey, you go get that money from your supplier. We're like, here's your claim, we'll go chase. And that complicates us. So that's kind of the first part of the supply chain issue. What was the second part? Sorry, Patrick.
No, it's just about like inflation concerns. I mean, we I know,
Yeah.
we do talk about that. How does it impact our business overall? But just let's
Yeah,
see if
I
there's
think
thoughts around that.
I think on the inflation side, the problem we've got is that we insure our companies from a financial perspective as a snapshot of where they are when we get on the risk. So if the value of that product goes up throughout the year, throughout the term of the policy, we do run the risk of inflation. We also run the risk of inflation because so many of the companies that we insure are selling components to third parties. So we don't necessarily know the value of that third party's product that incorporates that component or ingredient. So if that's swelling, we do run a risk because ultimately that third party's profit that they're making from that product and our insured then reimburses them for, we backfill that to our insured. So, how do we manage that? Ultimately, it's the structure of the policy more so than risk selection because we can't get away from it with risk selection. So what do? Limit management, attachment management. Thank you.
Larry, any thoughts or comments on the kind of supply chain or disruption of supply chain? I mean, it's, obviously this is kind of post-pandemic, but yet still very real in our world.
Sure. Yeah.
How things.
Yeah. I mean, initially it's very much like Mark. I mean, we have a claim, and then as it turns out, the claim was from a contingent provider from this. A lot of our supply chain risk is because a lot of networks are now intermingled. So, think of all the vendors that your clients are working with and how they're sharing data and all that, and that's where our biggest supply chain risk is. And then obviously in the broader sense, in the geopolitical sense, hackers are always trying to disrupt supply chain transactions. I mean, we saw large data breaches and a ransomware attack on the world's largest shipping line. So there's those supply chain risks as well. But remember, a lot of times, with our individual insureds, it spreads very quickly. So three operations down the line from you might have a breach that ends up affecting and destroying your computer system in its entirety. So it's obviously a big thing that we are consistently looking at. As far as inflation goes, really it becomes a lost cost issue at that point. Do the costs of replacement, do the costs of services that we are providing, do they go up as a result of inflation?
Thank you. David?
Yeah, so I mean, as we're seeing, and I think there's a prediction of the grain coming out of Ukraine as a result of the war and the delays to that having impact on global food supplies. I think political violence and terrorism does impact the supply chain. I think what we do see is insureds often requesting how can I cover this, and I think an important one is being able to articulate it's qualify the risk, but also really important, quantify the risk. If something was to impact your supply chain, what will it mean to you as a company, and how much will it cost you? Because if you can then articulate that, there's a thought that it might not just be the cost of the raw goods, it may be the additional costs and expenses to have, if ports get closed because of a particular incident, you might have to use alternative ports. So that those contingency plans, that's where almost the lateral thinking of around the product is you can get insurance to actually pay for those contingency plans that may be put in place. One of the biggest challenges any underwriter could face would be I don't know what the risk is. I don't know how it could materialize, and I don't know how much it's going to cost me. That's pretty much impossible to do anything about. But if you can qualify the risk, identify the risk, qualify the risk, and quantify the risk, then that is something that is insurable.
Yeah, good. One thing that I picked up on earlier that maybe Mark and David could to speak to is the workplace violence. Obviously, that's something that exists in our society, as the case may be. And I know that Mark and I have had a discussion over time talking about workplace violence being, I wouldn't say part and parcel to product recall, but certainly crisis management when you embrace an insured. And just want to get your thoughts around workplace violence, how that product currently looks, how it deploys. Is it sustainable? Is there underwriting capacity in order to provide that? Because again, I think there's a lot of people have to be very discerning between when you say political violence versus civil commotion and where all these products lie. But workplace violence seems to have risen to the top in a couple different product lines. And I'm curious where you think the cutoff points are, where the overlap is, or if there's no overlap. But just some comments around that, please.
Mike, do you want to lead on that one?
Yeah, I was going to say, first I was going to say that you said something at the end of your last point there, David, about an underwriter can't price something and can't figure out, what a loss estimate is, what can they underwrite. So having never done a deal with you, I'd be kind of terrified if you were my broker, because you might know how to price my business better than I might. But so I think workplace violence is kind of interesting, and it's kind of it's a little sad if you think about it, right? The reality is that there's definitely that exposure out there. I think in terms of the coverage, it's a little bit all over the place, right? There's the active assailant, there's the workplace violence. You see workplace violence is endorsements here and there. There's strike right, civil commotion. It's like, where do they all intersect? What are the dividing lines between all of them? It's kind of hard to put a finger on what does what. And I think ultimately, as you're looking at that, you also have to look at it in relation to workers' compensation and general liability, right? People are on the premises, they get injured. Is there truly an exclusion of a workplace violence on the premises? And is workers' comp compulsory or not? Texas, I don't believe workers' compensation is compulsory. So we've seen incidents where people have bought workplace violence that covers both employees and third parties, customers on the premise. So you've got a lot of question marks, in my opinion, in that market, because I don't think each coverage is created equal. I think everybody's coming at that from a slightly different arrangement. David, earlier you brought up the Charlie Hebdo attack. You said that was a terrorism incident, but yet I believe some of that occurred actually in the office, right? And then some of it spread out onto the streets. So in a situation like that, you've got something that's happening in the general public. It's municipal property at that point. You've got something that's happening on private property. You have an injury to insured persons. Let's assume that they bought coverage and those employees of that publication were indeed employees. But then you also have third parties on the street. So I think, the concept of getting terrorism, K&R underwriters, workplace underwriters, cyber underwriters, all into a room to try to agree where one coverage ends and another begins, that's probably too much to ask of the market at any given time. But I do think there's definitely a lot of ambiguity in these different coverages that are available to the market, whether it is active assailant, whether it is SRCC, whether it is workplace violence. We offer workplace violence as an endorsement to our policy. It's something we had launched before at a prior company and brought it with us. But our coverage is pretty strict. It's a death or injury benefit plus business interruption. And it's got to be on the premises. It doesn't matter if it's an insured or a customer. That's slightly different. It's more tied to property because of the business interruption element. It's not truly liability. So I think I wish I could give a more clear answer as to where the market is. I think the real issue here is where the market needs to get to. And then ultimately, I think one of the keys is, how do we in the private sector use a coverage like this and use either loss mitigation, training, consulting as a way to limit the potential for occurrence. Because when I started this, I remember I was at AIG in the early 2000s and they had this. One of the big perks they put on that was a vulnerability assessment, where you taught an HR team to come in and know warning signs from staff, warning signs from employees, because the way they articulated it sounded like it was a science. You could see if people had issues, and that if those issues were going to bubble over and lead to a violent incident in the workplace. The problem they had was a consultant they hired to do that. The cost of that work was, maybe the value was there, but it was prohibitively expensive for a discretionary buy. So they had a real tough time selling that coverage.
I guess sort of continuing that sort of theme around the discretionary buy, Mark, you mentioned earlier about the need and the importance of articulating the value of the product and the benefits of it. And I think that's something which everyone, both us brokers and you underwriters, need to work. It almost flies in the face of the traditional model of, I'm under no illusions of who I work for, i.e. the insured. But often with these sort of scenarios, it's really important to get the insured understanding what they're buying and what they're actually needing. And the only way that can really, is, Insurance 101, to create a meeting of the minds between underwriters and the insured to make sure that they know what underwriters know what they're selling, the insured know what they're purchasing, and to make sure that that's fit for purpose on both sides. And I think that's the development that needs to sort of almost that dialogue. And we pride ourselves on certainly in this space, actually bringing the insured and the underwriters together to make sure there's a full transparent understanding of the nuances of that particular insured's business operating model and the like. And for them also, for the underwriters to really articulate how the product is going to be of benefit to that insured. When something happens, what happens, how does it respond, what the expectations on each party are, so that it's a collaborative effort to get the insured through that issue. It's not about when a loss happens for the underwriters to sharpen their elbows and say, right, we're in for a fight here, guys. Let's wait for the lawsuits to come. It's about actually running to the risk rather than away from it. Because and then just tying back, Patrick, to the inflation aspect of things. I had an underwriter the other day saying they actually tried to make sure that if there is a claim to be paid, you pay it as quickly as you can, because if you delay it, inflation actually means you actually pay out more.
Absolutely. Excellent. All right, Larry, you don't get off the hook here. I've got a question for you that might be of interest to the group here. And you kind of helped me put the question together. So talk about just the changes in the corporate infrastructure as it relates to the pandemic, even though we're kind of on the backside of it. I think there was a lot of concern about folks working from home, what type of security they had maybe on their personal networks versus corporate. I think many people dial into a remote desktop that usually is corporately managed. But talk a little bit about that and what occurred, where we're at, and going forward in the hybrid model that I think a lot of people will be following here going forward.
Yeah. Well, so the good news on that is it feels, I don't have a lot of concrete evidence to support this, but it feels like corporate America has sort of caught up to where it needs to be in terms of those working remote who have access to remote capabilities are, being secured like they should have been in the beginning. However, as you all will remember, we shut down rather abruptly. It was 2 weeks and boom, we were done. Many organizations didn't know what they were going to do, how they were going to deploy a remote work environment or anything like that. And, that really gave sort of the hacking community a real opportunity, specifically in the education space, as well as the government entity space. So remember, who spends the least on, who has the lowest budgets on IT? Generally, it was governmental entities and education. Now, I'm not talking about necessarily the federal government, although they've had their struggles. over time. I'm talking local states and municipalities, and local school systems, and so on and so forth. And so, the majority of 2020, when we shut down, a lot of times they were logging in through their own personal networks, or getting email uploaded to their phone with no security, or just very basic security, and that really gave an in. We saw data breach, those two industries go up almost 1,000% just in a very short time span, which is why everybody on the phone who currently places cyber coverage knows how difficult municipalities in the education space is. And so really, that lack of controls that we saw as IT firms began to sort of, the IT response began to sort of figure out, how to best safeguard networks. There was a big lag time there, and so that was a big driver of claims through 2020, specifically with ransomware. Now, what has since transpired as a lot of analysis was done, and we've done, and I've done 20 years of data analysis, and I've looked at third-party tools, what causes a ransomware loss, and all that. And what we have sort of figured out as an industry is there's basically two specific controls you can deploy. That's multi-factor authentication. Let's be honest, it's a pain for everybody to go through, but you deploy that, and then your IT team takes data and encrypts it and backs it up offline every night, and you've turned a fatal car accident into a fender bender, basically. So that's like deploying airbags and all that. So that's why you're seeing the security posture and the burden of purchase in the insurance industry and the cyberspace going up pretty significantly. Everybody has to have a certain set of controls today that didn't exist 2 years ago, and certainly before that. And we kind of got caught blind for a little bit there.
Thank you for that. Moving on here, just a couple more questions. We might actually finish up early this morning, but want to kind of go around the horn. We're all consumers, myself included, of Lloyd's capacity. And when we're in broking our property book, we're always talking about sustainability and profitability and making sure we put emphasis around risk selection. And I always thought I had it easy until last week when Storm Ian hit the Florida and Carolina coast. So I've got a new hurdle to climb or jump over. But just some thoughts and comments around current capacity, what's available. I presume it's probably a combination of managing line size on a particular deal based on who that capacity provider is on the back end. But also, I guess you put it in the same, maybe put it in the same vein as, sustainability. Are the products, these are obviously very, we're going to be operating in a volatile space for sure with these three product lines. What happens on a daily basis when you're talking to your capacity providers? What are their concerns, and kind of what, little crystal ball on what the next 12 to 24 months looks like. Larry, I'll just continue with you because I can see you've got your mic open there.
Skip, move on. I don't want to talk.
No.
Yeah, so we are kind of on the backside of you put it in terms of Hurricane Ian. We're kind of on the backside of a perfect storm of a cyber hurricane / pandemic moving into an endemic phase. So we've obviously had a significant amount of challenges in the capacity space. I mean, at one point, we in particular approached 68 of the 72 London syndicates that underwrite cyber, and either everybody was holding on to their current programs to see what happens, or were just declining any kind of new program. So capacity's been a challenge in cyber, in the cyberspace. We've seen MGAs lose their paper, and unfortunately, some of them have then, gone out of business as a result. What I will say is I'm a lot more optimistic going forward. We're starting to see that tide turn a little bit. Loss ratios, as an industry, we've gotten a better handle of things. Our aggregation models have improved significantly, and a lot of those concerns of the broad delegated authority underwriters are starting to be alleviated a little bit. The introduction of technology, so new scanning, some of these insurtech tools that we're deploying, we're all building out some pretty dynamic risk management platforms that will help. We're never going to stop cyber loss, but we will hopefully severely mitigate, or at least reduce the amount of claims we're going to be seeing. And so I'm very hopeful. The one area that's a challenge right now and continues to be is technology. We are currently still without capacity on the technology side. And just given some of the technology infrastructure threats that we see, some of it in David's area where it's geopolitical and, from nation state actors and stuff, that still remains a big area of concern. So we're not without our challenges, but I'm very bullish and hopeful that the capacity situation is going to change for us all in the cyberspace. Do I think, for the brokers on the phone, that the market's going to go back to those days where you're going to see 5 million limits for $3,000 and all that stuff? Now, there are insurtechs that have some of those pricing models out there, but no, I still think we're going to see, and hopefully we see, an industry that's much more disciplined in their approach and the limits they put out, revenue sizes they're looking at, and sort of paying attention to aggregation going forward. But I am very confident we're going to start seeing the capacity kind of come back.
Very good. That's good news. That's encouraging. I know you've been on a long trail, so I'm pulling for you, buddy. So, Mark, what does the capacity fairy have in store for you?
Thank you for that term. So, for some of you may not know, we came over to Dual last year and had some challenge putting our capacity together, but we're able to put it together. But Patrick would often come to me and ask, has the capacity fairy come to visit you yet and given you capacity? And now we have ample capacity. So I'd say a couple of things. I mean, fortunately, we don't have quite the challenges that Larry's gone through on cyber, because our market doesn't have the pressure on it, frankly. But we've got a different pressure on our market. While we've got competitors that may be unprofitable here and there, there's ample capacity, which tells me that the market overall is very profitable. The reinsurers who kind of dominate this space, a lot of them are in Central Europe. They've been in this space for 30 years. So obviously they're making money. That's why they're still here. But the issue we have, honestly, is that the capacity is available, but a lot of times the capacity wants to be deployed or deploy where everybody else is. So, the food industry is the biggest buyer of our products, which also means it's the most competitive, which also means that rates are lowest, coverage is broadest. And the challenge we have is convincing that capacity to look beyond food and to go to the edges of the market and to be daring, to go where there's less competition. Because frankly, that's where the balance of a portfolio comes in. That's where the sustainability comes in a portfolio, the ability to spread your risk, diversify your risk, and balance that out against different experiences. So while there is ample capacity, a lot of our challenge is coming to these capital providers and convincing them, sometimes slowly, sometimes begrudgingly, to deploy some of their capital in less traveled areas and less trampled paths.
David?
Yeah, so I mean, it's been an interesting, as I mentioned in my little introduction, the amount of capacity that's come into the standalone market has grown and grown and grown. And it has undoubtedly been a very profitable sector of business. The interesting conundrum for a lot of underwriters at the moment is that whilst the insureds have enjoyed cheaper rates and cheaper costs for this product, so too insurers have enjoyed cheaper reinsurance rates. What we're seeing is a very interesting thing with what's coming out of the war in Ukraine is a lot of losses coming out of the 47 providers in London of political violence. They feed into 8 treaty reinsurers. So they're going to be hit left, right, and center. So we are going to see an increase in their treaty reinsurance rates, which will then impact other rates. But in terms of capacity, I don't think I think we'll see probably a recalibration and kind of pulling that, using an English phrase, pulling up your socks in terms of the discipline of underwriting, making sure you've got adequate pricing, risk appropriate pricing, and deploying appropriate levels of capacity. That's saying that, putting my broker hat firmly on, there is a lot of capacity out there. It's still a very competitive marketplace. It's still a very profitable book of business. So there's there's competitive capacity out there. I'm not worried about that. I think if one was to have a very niche territory which you work in with real supply and demand constraints, I think you'd be concerned. There's been a lot of growth in terms of some standalone risks as the market for the all risk starts to retract or make it so it's not as appetizing to be on a particular placement for the peril of terrorism. They go, you know what, just carve that out, do it separately. That has created some supply and demand constraints in certain central business district areas. But it's still, there's a lot of capacity out there. So I'm not necessarily concerned about that. It's just, my job as a broker is to know the market and know where that capacity is and where to find it.
Yeah. No, that's good. That's helpful. Thank you. Yeah, I think you're right. I think, I think with any product line right now, certainly probably any market, whether it be Lloyd's or elsewhere, definitely emphasis on flight to excellence, deploying the capacity with those that know how to use it and use it best. Final question here, just as we kind of wrap up, and again, we're a little bit ahead of time, but that's okay. We'll give some time back to the folks that are on the call today. Advancements in product evolution, and maybe the answer is yes. There's some thoughts out there, but maybe we're just happy to have what we have, and maybe that's more of a timing issue into the future. But Larry, do you have any thoughts or comments around that?
Like the evolution of the cyber product in general. Yeah, I think I touched on it a little bit. What we're going to start seeing is a more technology risk management based product, and coverage is going to respond directly to it. Sort of what David and Mark talked about before. We actually do like to run towards potential cyber claims, not wait them out and try to defend them for a whole host of reasons. So I think you're going to see a much more significant rapid response. At the same time, I do expect to see coverage sort of compress a little bit. So, as we refer to the supply chain, we're going to see a lot less of my brother's sister's cousin's system went down and that knocked my system down. Therefore, we're all going to get paid out, 7 figures on these losses. You're seeing carriers are tightening up those positions, also working with people like David and Mark on things like product recall in the cyberspace and potentially, how do we respond in cyber for acts of terrorism? You're seeing some pretty large carriers who write a lot of cyber business starting to introduce language, to the effect of identifying whether it was a targeted malicious attack or a expanded aggregation issue. So, and then whole concept of nation state versus individual hackers and all that. So, you're going to see the coverage, be, I guess, cleaned up a little bit to address those things. So there might be some compression in the coverage. But I do expect it to kind of evolve to a more technology, immediate incident response type policy form.
Good, thank you for that. Mark?
I mean, I think, for all of us, it's a fight for relevancy in a lot of cases. I think, current events can help that. When there's a cyber event that's going on, it helps Larry. When there's a recall event or a contamination event, it helps me. When there is a terrorism or a political violence event, it benefits David because it increases, like free advertising. But we have to take advantage of our platforms, right? We're all, for the most part, ENS. We've got freedom of rate and form. We've all got the experience. I think it's so much easier to underwrite to a claim than it is to a company. And we've all seen the claims. So we kind of know what can go wrong. And I think our challenge is to increase our relevancy to the buyer. So based on that, the coverage has to evolve. Where our coverage is going, I mean, I kind of touched on that, I hope, in my intro, which is we need to be more relevant, not just by what the coverage does and what it pays, but in how it speaks to the buyer, how the form speaks to the buyer. A lot of our forms that we've changed over the years, we've taken input from contracts between a supplier and a customer. And we've looked at what those suppliers are guaranteeing or promising to their customers. And we've taken that language into our wording so that if a GC picks up our policy and reads it for the first time without any consultant over them telling what it does, they see terms in there and realize, hopefully, oh, these guys understand what my exposures are. Right? They understand that I have epidemic failure exposure. They understand that I have unfit for its intended use. They understand that I have failure rate triggers in here. So it's that kind of stuff where it's important as an underwriter that you listen to your customers, that you listen to your brokers, that you listen to your claims, that you understand your claims, that you're involved in those claims, you understand what's happening, so that you learn from those claims and you bring that language in. Because to David's point earlier, you need data to underwrite. You don't need a ton of data, but you need something to sink your teeth into to begin to plan out a payback model. But if you can get that, you should be able to eventually find a solution that company can risk transfer that to us. And I think most importantly, it's about paying claims. You got to pay claims. It's like even those ones that are gray and they're not perfect and they don't fit this widget of your policy perfectly, but you understand that generally speaking, your intent was there. There's a lot of pressure on us to pay those claims because ultimately, if you're not doing that, you're not going to be around.
Yep. Good point. David, we'll wrap up with you here.
Yeah, I just echoing Mark. I mean, I think, claims are obviously the shop window of the insurance industry. And if that's not being, disputed claims are toxic for everyone. So I think it's that having that understanding and of the insured's understanding what they're buying, and I guess the onus on underwriters and brokers to learn from claims so that it can be less disputed and less traumatic for the insured. I think anybody who has experienced a sort of a coverage dispute it's horrible. So I think the evolving of the evolution of the product is about having it properly articulate what it's trying to cover, but also opening it up so that there is that dialogue for the insured to articulate what they need the coverage to do as well, so that it's it's relevant and pertinent to that particular insured. So I think that's it's all about that communication and dialogue, and that will evolve the product to learn from oh, actually I hadn't contemplated that an insured would value that. We brokers say you learn from your broker as you go around, as you see different underwriters, you go, okay, that particular underwriter values that bit of information. I'll be sure to include that on my next conversation. And you sort of in a similar thing with the insureds and the underwriters to learn what's of value on both sides. So it can, you know, these discretionary products are much more attractive.
Yeah, for sure. Well, thank you for that. And on that note, we're going to wrap it up for the day. I wanted to thank the three panelists. It's been very enlightening. I think the topic was right. I think your participation in the three different verticals was perfect, because there's a lot of overlap, a lot of good information that was discussed. I've seen a couple notes come across that are we finishing early? Are the 3 hour C credits still available? Yes, this has been registered with the individual states where C is available. And so, Mark Rector will be sending out a note giving you access to how to register to get your CE. But on that, fellas, again, thank you. I know we've got a lot of different time zones covered here, and I really appreciate your input in helping the ALB put a great presentation together. For those that are on, if you need to contact any one of us individually, if you have something that's pressing or a question that wasn't answered, we'd love to hear from you. So with that, everybody have a good day and enjoy the rest of your week. Thank you very much.
Thank you.
Thank you for hosting, Patrick and Mark.
Thanks.
Thank you.
Thank you.
Bye-bye.